Andrew, thank you for being on the show.
Oh, my pleasure, Carl. Thank you very much for inviting me.
When I saw the title of your last book, or let's say the third edition of your last book, The Expat Millionaire, I felt compelled to read it because I'm an expat myself. I'm doing pretty well financially. So I said, this book is for me. I got to read it. And I enjoyed every page of it. Wondered, but why on earth did Andrew focus on expats like myself this time? This is not your first book by any means, and not your first book on personal finance. So why do you think expats do need special care and attention?
Yeah, that's a great question. Often as expats, especially when we're looking at a region such as you were in, where as a non-resident of Italy, for example, you don't have to pay income taxes.
Yep.
Right? So we can be in situations where we are on business packages, where in some cases we're working for corporations that are paying some or all of our housing. And so it seems like we've got so much more disposable income. And we do. However, as expats, we're not contributing to our home country social platforms. We're often, in most cases, not contributing to defined benefit pension schemes. And so I'm talking about like corporate pension schemes or government pension schemes. So I'm not talking about, when I mention the word pension, I'm not talking about investments. I'm talking about like working for a corporation for a certain number of years or for a government entity, at which point they will determine a fixed amount per month that you'll be receiving in your retirement years. So that's obviously really common in a lot of first world countries. But then when we move abroad, we're often in a situation where we're not contributing to those social platforms. And when we aren't contributing to them, we aren't going to be eligible for the full benefits of them when we get older. So there's realization number one. That's one thing that I suppose it should be a realization, but it's a challenge. The second is, with generally a little bit more income, we tend to spend more income. Often the more we make, the more we spend. So we don't necessarily look after the future. Number three is, because we end up in an environment where we should be saving a little bit more money, we become susceptible to financial salespeople that will sell us or try really hard to sell us incredibly high fee products that may not even be legal in our home countries, but are legal in jurisdictions where maybe the financial regulations are a little looser. And so we end up often buying into these products that have such high internal fees that we have very little chance of making decent money. And we need to make money for the reasons, or we need to grow our wealth for the reasons I talked about earlier, with respect to the lack of government pensions or defined benefit pensions for most people who live abroad. So writing Millionaire Expat, it was just one of those natural transitions from my first book, Millionaire Teacher, which I wrote mostly for an audience that lives in Canada and lives in the United States and lives in the UK and Australia. And so mostly that was my audience. But then people would email me and they would say, like, I'm Spanish, I'm living in Egypt. How do I actually build a portfolio that you talk about in your book, Millionaire Teacher? So it was just that natural transition to go from there to write the book, Millionaire Expat.
You have touched on those salespeople selling high fees retirement plans. Before we touch on them, because you portray them in quite a unique way in your book, but I understand that you address your book mainly to, let's say, middle-class people. And your contention is that they may live and work as middle or slightly higher class, but they can retire as millionaires. Is that correct?
Yeah, absolutely. Absolutely. If they invest properly, if they think a little bit about how they allocate their money. So a really large part of this is not necessarily always how much money you make, but what you do with the money that you make. So you're somewhat careful with your spending. You know, you're not crazy exuberant. And I think that many expats fall into this. And I call it, in the book, I call it expatitis, like it's some kind of disease. And it starts off really innocently, where we start living a slightly higher standard of living while we're abroad. And the people around us are doing much the same. And that can be fine, but we don't want to get too carried away, at which point we're not saving enough money for our future. So that's a really big deal. And it's something that we need to be careful of, especially as expats.
What would be a wise behavior, in your opinion? Getting rid of that, I don't know, Starbucks coffee every day. Where should an expat start saving their money? What is it that they should either not buy or postpone in the future?
Yeah, that's such a good question. So let's take the Starbucks example, because so many people will, other financial writers will talk about this and say the latte factor, for example. They'll say, well, if you decide to have your coffee at home instead of enjoying it in a cafe, you'll end up potentially, if you invest the difference, you could have an extra $1 million by your 65th birthday. Mathematically speaking, that is correct. However, there's a life to live here. And the important part of this is recognizing, what am I actually getting out of that cup of coffee? So if you are enjoying that cup of coffee with friends, like you're legitimately sitting around at a cafe, enjoying the company of other people and sitting and enjoying that coffee, then that's not an area where I would scrimp. That's not an area where I would cut back. However, if you are grabbing that cup of coffee on the run, so you're driving with an expensive cup of coffee to work, for example, you're not thinking about how delicious the coffee is. You're not enjoying it with friends. Your mind is on other things. You're thinking about the traffic. You might be thinking about picking up your children after work. Your mind is elsewhere. It's not on the coffee, and it's not on a social circumstance. In that case, an expensive cup of coffee is a waste of money. You could have just put coffee in a thermos from home and saved yourself some money, therefore taking that extra savings and theoretically investing it for your future. So Carlo, there's a balance here with respect to what are we actually getting out of it in terms of our lifestyle, because money is a tool. And so it's a tool by which we need to find a way to enjoy it and find some kind of balance with it. So that would be my response. That would be sort of my litmus test, or one of them, that people need to consider when they're looking at actually cutting back on something so that they can save more money.
I love that, Andrew. And this resonates so much with me and the industry I come from, the luxury industry, because as you may imagine, saving money is not on top of priorities of whoever is involved in the luxury industry, right? Because you want to promote the opposite of it. You want to promote, enjoy your life, celebrate it, have the finest things in life, experience the finest things in life. But there's no such thing as enjoying the finest things unless you develop an appreciation for them, which is exactly what you just said. If you don't have the time or the capacity to appreciate it, get rid of it. You don't need it. You don't need to waste your money and energy on something that is useless, and perhaps save it for better moments and something more meaningful. Is that correct?
Yeah, that's exactly true. It's interesting when we look at happiness research, like life satisfaction research, and what actually is it that makes us happy and content. And largely it's the experiences that we have. And so if you're spending money on an experience, this is truly worthwhile. This is the sort of thing that builds your life satisfaction. So you and a group of friends decide that you are going to do some heli-skiing on a glacier in the middle of summer. You're going to remember this. You've built an experience with people that you love and respect. So whether that's with your family or whether that's a group of friends, it's the sort of thing that nurtures and solidifies that on a psychological level. Like years from now, when you're sitting with a group of friends reminiscing about your life, you're going to bring up those experiences that you had much more than you will bring up the things that you perhaps purchased back in 2025 or 2030. So my suggestion when people are looking at luxury things and they really want luxury things, I say, think about how the luxury thing contributes to an experience, something that relates to a memory. And that's where I think most of your focus should be when it comes to actually enjoying the money that you have.
I totally agree. Now, let's discuss those figures that you portray in your book as some sort of monsters attacking people's hard-earned capital, financial advisors, and particularly those selling these retirement plans by large insurance companies. Who are they? What do they sell in the end?
They are typically the firms that create these specific products can be well-respected insurance companies, mostly based in Europe. So they're well-respected insurance companies. In the 1980s, they created a group of products called an investment-linked insurance scheme. And they were incredibly high-fee products, incredibly complicated in terms of looking at the prospectus and trying to figure out how they actually work. Like, what are you being charged as the person that purchases these things? Now, some of these products, they're basically all of them that are sold for the most part in the Middle East, places like Africa, Southeast Asia, even some European banks. They have a internal fee structure that is so high, it's really difficult for the investor to beat inflation long term. And there's a massive incentive for these people that sell them to you. And they get massive commissions for doing so. So for example, if I sold one of these to you and it was a contractual savings scheme and you were going to invest $2,000 a month, what I would typically do if I were the salesperson, and this is what I see, so this is what the salespeople typically do, is they'll put you into a 25-year plan. You might not even really know it's a 25-year plan, but they get a bigger commission if they put you in long-term. I, as the salesperson, would end up with a really, really big commission the moment the contractual ink dries. As soon as I get your signature and submit the paperwork, I would be entitled to, in this case, if you were investing $2,000 a month, I would get an upfront commission of $27,000 from you. Thank you very much, Carlo. Now, I would split that. I would end up getting about 70% of that, and my brokerage that I work for would end up getting the remaining. So in the book, and I know online, and especially when you're dealing with an audience in Dubai, it's important that we not name firms. However, in the book Millionaire Expat, I clearly laid them out. So I said, here are the companies that we need to try to avoid no matter what. They're the most common financial service operators in the UAE. So they're the ones that will cold call you. They're the ones that will send you emails. They're the ones that will be potentially cozying up to you at a party. Financial salespeople that you meet on a golf course. Great financial products and great financial advisors actually don't go looking for you. You have to go looking for them. So if somebody is hunting you down, you've got to really think about why.
I have quite a few friends involved in these pension schemes. And what sold them these financial schemes is the fact that, first off, they don't need to think about allocating their capital. They know it's $2,000 per month, $3,000 per month. It's clear. It's simple. They don't have to think about it. And it's also a way for them to feel that they are saving. Second, and this is where I have a question for you. When they look at the fees, they say, but listen, it's 1 or 2%. 1 or 2% is nothing. The average actively managed fund has managed to collect 7, 8, 9% growth over the years. What is 1%?
Yeah, it's a great question, because what will happen is that there's a lot of smoke and mirrors here. Because first of all, they cost much more than 1%. They might show that on the prospectus. They'll say, 1.5% annual fee. However, usually they'll charge a really high fee on the contributions that you make during the first 18 months. And that the total fees on those contributions that you make for the first 18 months end up attracting fees of about 9% per year, which means that the money you've invested over the first 18 months, that pot of money that you've invested is money that will never grow. You'll never see growth on that. So the funds, not only does the insurance company levy a fee of, say, 1.5% or more, each fund also has an expense ratio. And it's the cost of actually internally running that unit trust or that mutual fund. And that will not show up on the prospectus that the insurance company will give you, but you have to add that in. They also often end up charging mirror fees. So it's an extra 1% on top of that. So if you are investing in a contractual savings scheme in the UAE, you are most certainly paying annual fees when we combine everything together of between 3.5% to 4% per year. And even that, Carlo, people might say, well, okay, and even if that's true, that's not such a big deal. But just for your listeners here, I'm just going to give an idea of how impactful that can be. So just as an example, assume that somebody had $10,000. They didn't add anything to it. And let's assume that it just grew for 50 years at a rate of return of 8%. So when we compound that out over 50 years at 8%, it works out to about $467,000. Okay, so what happens if we deduct 3.5% per year in fees? So now instead of earning 8%, the investor earns 4.5. So most people, when I ask them, what would they end up with? In the first scenario, if it's 8%, they end up with 467,000. If they pay 3.5% in fees, therefore their annual rate of return is 3.5% lower, what would it grow to? And most people are really surprised to know this figure. Instead of it being worth 467,000, it's worth about 90,000. And so, of course, the rest of that money finds its way to the financial services industry in one form or another. The investor is the one who gets the shaft.
Wow. So this is the problem. And before we move on to the solution of the problem, let me just ask you, but why do they do what they do? I mean, like you, I travel the world and I meet hundreds of people every year. And I have to tell you that most of the people I meet are well-intentioned. They make mistakes. They don't necessarily work in full transparency. There is always a level of conflict of interest. But most people I know try and do their job in the most transparent way. Why do they do what they do?
Yeah, that's interesting, because when I first started looking into these, I assumed that these people are evil, that they would, to their benefit, make decisions that would cost other people their futures. And while I believe there are people like that who will do that, I believe that they probably are in the minority. And as you say, most people are actually well-intentioned. And most of the financial advisors really, or the financial salespeople, really don't know or understand these products to the extent that they should. So all they realize is, when I sell these, I make a really big commission. It's a really big insurance company that has created the product, and so must be a decent product. I do well. I'm assuming my clients will do well, and that's about it. So they go on then to try to sell more, because they're paid based on a commission structure. So they're not getting paid on an annual basis based on assets under management, but they're getting paid just based on commissions. So they go out and rinse and repeat, and try and find as many clients to sell as many of these products as they can. So I don't think they're bad people. Interestingly enough, there's a study done in Canada. And in Canada, we don't have any products that are actually this bad. They're not legal. We can't sell them in Canada. And that's where I happen to be right now. So I'm saying I just happen to be, I am a Canadian, and I'm in Canada right now. The United States, Australia, even the UK, they have put a ban on such commission-based schemes. So financial advisors in these regions can't sell such high commission-based schemes. But even here, like I take this example of Canada, even here, when you take the typical financial advisor, they actually don't understand to what extent fees impact returns either. And the reason we know that is there was a fascinating study that was done on certified financial planners, financial advisors here in Canada. There were a series of banks that ended up cooperating in this multi-year long study. And they wanted to see, well, what were the actual financial advisors putting into their own accounts? They were largely putting into their own accounts the stuff that in the book Millionaire Expat, I'm telling people that they shouldn't be buying. They're following and purchasing, I suppose, and it's very natural to do so, funds that have had good 1, 2, 3, or 5-year performance records. But what's strange and what they don't learn is that funds that perform well during one time period often are the same funds that underperform during another time period or the following time period. So they end up chasing their own tails. And the research found that in Canada, financial advisors would underperform on an equal risk adjusted basis, a portfolio of ETFs or index funds by about 3.5% per year. And so we talked already about the compounding effect of fees and underperformance, and it's absolutely devastating. And unfortunately, these advisors end up eating their own cooking after they've burned it.
From what I understand from you, I think the word financial advisor doesn't really apply here. They're more salespeople than financial advisor if they don't really understand the product they're selling. As much as we don't call car salespeople automotive engineers, we shouldn't call these people financial advisors, isn't it?
Yeah, it's funny because, when I said it, I actually stopped myself and I was talking about financial advisors in one of the examples I was giving you. And then I actually corrected myself and I started calling them financial salespeople, because truly that's what they are. They are, for the most part, they're not putting the interests of the client first, whether they are doing that intentionally or unintentionally. So we really should be referring to them as financial salespeople first and foremost.
Okay, so let's try and find solutions to the problem. Where shall our audience go to? The stock market? Should they try and time the stock market and cherry pick the winners so as to compound the growth of their capital over the years?
That's the most natural thing to actually think, but the easiest thing to do, and it is quite simple, like my investment portfolio, I've been investing in the stock and bond markets for 33 years. So I started when I was 19. And I spend less than an hour a year thinking about my investments. And yet my investments have outperformed the vast majority of hedge funds, the vast majority of college endowment funds, the vast majority of actively managed funds. And I haven't had to do anything. Like I haven't had to do anything that is special. What I did was I just followed peer-reviewed academic evidence, and you could do much the same. Your listeners could do much the same. And this really does involve purchasing a product such as an ETF that ends up having the world's stock market comprised within it. So literally 7,000 stocks, let's say, in a single product. So that single product is fully diversified, as American stocks, Italian stocks, Australian stocks, Canadian stocks, Chinese stocks. So it's an aggregate of the world's returns. And peer-reviewed financial evidence suggests that when you own one of these products and you don't do anything, you don't do any timing, you just, when you have the money, you just add money to it, you will beat the vast majority of professional traders over your lifetime, even over a 10-year period. And so it sounds so simple that people are often saying, well, it's got to be more complicated than that. The only complicated part is human emotion. It's difficult to actually have ourselves follow through with such a disciplined plan.
So it's one ETF or a number of ETFs that cover different markets, industries?
So what's really simple is you could do one of two things. You could buy a global stock market ETF and a global bond market ETF. So that's really the simplest. So you could have Vanguard's FTSE All World Stock Market ETF. The ticker symbol is VWRA. That can be your stock allocation. Then you could have a global aggregate bond index. The ticker symbol is AGGG. And you could have different proportions depending on your tolerance for risk. So for example, if you feel or would feel relatively comfortable seeing your portfolio in any given year potentially drop in half, and stay down for a couple of years, if you're comfortable with that, and you're okay with that, then you could go with a high stock allocation. So you could go with something like maybe 90% or even 100% into the stock market index. If, however, that would freak you out, and it would freak most people out to see their portfolio get cut in half, especially if it stayed down for 2 or 3 years, then you would want a bond allocation as well, which will ensure that your portfolio doesn't fall as far. So that ETF that I mentioned here is just an example of one. AGGG is the ticker symbol. So somebody could theoretically have 70% of their money in a global stock index, global stock ETF, and let's say 30% in a gold market ETF. And then when the stock market drops, this diversified portfolio won't drop as far. And so each year, what you'd want to do is you'd want to try to rebalance it back to the original allocation. But what's really cool is, and I talk about this in Millionaire Expat, is we now have all-in-one portfolio ETFs that we can choose, which include the global stock markets and the global bond markets in a single product. So I listed those in Millionaire Expat, and they, Carlo, make the whole situation so much easier. If this is too much work for you, you're saying like, I don't want to do this, you could hire a robo-advisory firm, such as in the UAE, it could be Sarwa. Sarwa will do this for you. So they will build a portfolio for you. They will charge you a small annual fee, and it is relatively small. They'll rebalance that portfolio for you, and they'll be there to give you financial planning advice if you need it. For really high net worth clients with a lot more money, there are several full service financial advisory firms that deal just with portfolios of index funds or ETFs. Those are the full service financial advisors that I recommend. So they don't try to time the market. They don't try and find you the next hot stock. They will build you a portfolio of low cost ETFs. And there are several of them in the world.
So you mentioned low cost ETF. What's the difference in terms of percentage of fees between a low cost ETF and an actively managed ETF?
It can be anything. It can really be all over the place. A low cost ETF, though, generally is something that costs, say, less than 0.25% per year. Could be even as low as 0.03% per year. There are some actively managed ETFs that will charge you 1.5% per year. So significantly more.
Let me tell you an objection that I'm likely to hear if suggesting anything like that to the people I know, and perhaps myself too. They tell me, yeah, but I would have missed Nvidia's growth. I would have missed Tesla's growth that made so many people rich. I would have, where's the action?
I think the action should come elsewhere. The nice thing is, if you have a portfolio of ETFs, you've actually already participated in a piece of Tesla's growth, a piece of Facebook's growth, in a piece of Netflix growth, because they're part of that global stock ETF. So you've already participated in that. But if your heart rate is quickening as a result of investing, if it's actually exciting, you might be doing it wrong. So investing really should be about as exciting as watching paint dry. We have to think really long term and putting the statistical probabilities of success in our favor. And the odds are highest when we literally don't think about our money, add our money to a globally diversified portfolio of ETFs with a bond allocation in the mix there that aligns with our level of our tolerance for volatility, and then getting on with far more important things in life. And so I said in the beginning, earlier, I said I spend probably an hour a year thinking about my investing and making my investment decisions. And I'm not joking. That's what I do. I spend about an hour a year.
Andrew, are you still spending an hour a year now that the world is getting so complicated? Not that it was not before, but we are experiencing extremely turbulent times. The war in Ukraine, inflation at record levels, commodities, let's not even get there, supply chain disruption. Are you still at ease with knowing that you take care of your money an hour a year instead of focusing more of it, and try at least to do something about the things that are happening around us.
Yeah, there's something called the heuristic bias, which means that whatever we see right now, we think is the worst thing ever.
Yeah.
But if we go back in time, we notice that there have never been predictable times. So we could take a random year, 1982, for example. 1982, we had inflation levels that were running 12, 13% per year. That was an uncertain time. We had mortgage interest rates that were charging as much as 17 or 18%. We had high oil prices. We had so much uncertainty. The stock market in itself, now this is an interesting thing, Carlo. From 1965 until 1982, that's a 17-year period. The S&P 500 index did not beat inflation. However, anyone that was just continually putting money in the stock market during that time period and ignoring all of the quote uncertainty and the fear. We can't forget too that we were probably much closer to nuclear war then than we are today. I mean, the Cold War was real. It was a very, very real threat between two massive superpowers who were, we were terrified. But people often forget that and only look at what's actually currently happening today and figuring that whatever's happening today is the worst thing ever. So yeah, the best thing to do is to stay calm and carry on, because there have never been predictable times. The Great Depression wasn't predictable. World War II wasn't predictable. Interestingly, if you look at the worst time in history to have lumped $10,000 into, let's say, a US stock market index, if they actually had one, the worst time in history would have been 1929. Yeah. But what we need to do is not think so much about what's happening today or this year or what might be happening next year. It's to only and always think about 30-year durations, because they're really the only ones that count. Now, even if someone is 60 years old, if they hope to live until they're 90, their investment duration is 30 more years. So we need to think in terms of 30-year durations. So the fascinating thing is, we take 1929. It would have been the worst time to lump in $10,000 investment and leave it, right? It actually would have been better if somebody could have just invested monthly, just kept on adding money, because in 1929, 1930 to 1931, during that time period, the stock market dropped to the point where it was down nearly 90% by 1932. So it was a crazy drop. However, what would $10,000 have been worth 30 years later if it were invested in 1929? So make your guess, just for fun.
$10,000 by 1939.
So by actually 30 years later. So
30 years later. 30 years later.
Yeah, 30 years later.
50,000.
108,000. So wow. It would have grown by a compound annual return of 8.24% per year. That's the worst 30-year compound annual return. And so if that's the worst, and we think, wow, think about everything that went on during that time, Carlo. The Great Depression, World War II, the Korean War. I mean, these things that were happening then were crazy. It was a crazy 30-year period. The Cold War in itself was scary as hell. But if people were patient, especially if they were continuing to add money during that time, and if they added a consistent sum, close their eyes, close their ears, their dollar cost averaging would have purchased more stock market units after the markets had had bad years, and fewer stock market units after the stock market had had good years. The investor wouldn't have had to think about this, but they would have paid a lower than average price. So this is what I recommend to people: is ignore what's happening in the news. Don't try to time the market. Don't try to speculate. Peer-reviewed academic evidence suggests that that's really, really, really hard to do.
It is. What's your view on cryptocurrencies and NFTs, which are these new emerging hot asset class that everybody talk about, and some people made billions out of?
I prefer to keep things really simple. For me, my interest is more in something that has actual cash flow. And so properties have actual cash flow, and real businesses have cash flow because they can sell products. They can show actual profits. So when we're buying an ETF, for example, we have real companies within the ETFs and they're producing cash. When we're looking at a cryptocurrency, it's more of a speculation than it is an investment. And so for me personally, although there are people who have made a lot of money with it, for me personally, I prefer to see it as a speculation. The interesting thing about it too is that it's very popular after it's had a really big run. I believe Bitcoin's probably down about 30% over the past 12 months. What's fascinating is fewer people are interested in it today than they were 12 months ago. The strange thing is people like to buy things after it's gone up a lot, and they're not as keen on it after it's gone down. And they're like that with everything, whether it's real estate, whether it's stocks, whether it's cryptocurrencies. With cryptocurrencies, people are so interested in a lot of them, don't understand it, and they're really interested in the fast buck. And so most of their money will be piling in after it's done really well, and often piling out after it hasn't. So it's more challenging than anything else. But for me, my preference is real businesses and real estate. To me, cryptocurrency is more of a speculation. It's probably better not to invest any more than you could afford to lose.
Yeah. And how about store of value, such as gold and silver, for example, and perhaps pure gold and pure silver to be stored out of the banking system? Do you look at it as a safer option for a portion of the portfolio, or again, it's not producing cash flow, so not of your interest?
It's interesting how when we ask people about gold, because if I asked, what would it be worth if I bought $1 worth of gold in 1801, what would it be worth today? And it would be worth something like $100. It's not worth a lot. Sounds like a big gain, but if you were to invest in the US stock market and you had a way of divvying up that same $1, put it into all the stocks in the US market and just held them. Some of them would have gone bankrupt, some of them wouldn't have, some of them would have merged with others, but that same $1 would be worth about 14 or 15 million today. And so gold long term doesn't really beat inflation. It'll have periods where it does. And interestingly, again, that's when people get really excited about it. They mostly like to buy it and bandwagon on it after it's had a really strong run. And they're a lot less interested in it after it's fallen a lot. So I would say that with something like gold and silver, again, a bit more of a speculation, because on aggregate, long term anyway, long term, they really don't beat inflation.
Andrew, before I thank you for this very interesting and thoughtful conversation, let me ask you one last question. Since I trust that many of our listeners and viewers may be intrigued at this point in time to start looking actively at their financial life and not delegate it to professionals, so to speak. Do you have any recommendations in terms of books, people to follow, of course, beside your books and beside following you, something else that could help them understand the scenario a little bit more in details?
I think one of the best pieces of advice that I could give is there's a guy in the US who deals with people of like more than 100 different nationalities, people all over the world. And he helps them build, or he helps them open up brokerage accounts and shows them how to actually purchase exchange traded index funds, such as what I'm talking about here. So he works for a firm called Plan Vision, and his name is Mark Zorel. And I mentioned him in the book, Millionaire Expat, and I believe he charges about $200. So he doesn't manage your money for you. He just shows you how to open the brokerage account, what to buy, and how to actually purchase it. And it's really simple because the whole what to buy thing is incredibly simple, and that literally it's global stock index and a global bond index, or an all-in-one portfolio ETF, which is even simpler. He shows you how to make those purchase transactions. He'll charge you about $200, and you can contact him throughout the year and ask him as many questions as you want. So your $200 lasts the entire year. And then after that, you can keep him on retainer for as little as, I think it's $8 a month. People love him. Anyone who has read, say, one of my books who wants to know how to actually do it, because now how do I actually do it? Plan Vision is a great place to start. You go to any expat forums, don't take my word for it, just go to an expat forum and say, has anyone used Mark Zoril and Plan Vision? You'll end up getting floods of people that said, yeah, he's great, really helps me a lot, keeps me on track. If you're looking for something like some great YouTube videos, there's a firm out of Canada, there's a guy named Benjamin Felix, who has put together, he works for a firm called PWL Capital, and he has put together some of the best educational videos on YouTube, explaining the process here that I was talking about with you about gold, about how to build a diversified portfolio of ETFs and the importance of not trying to time the market. And he gets into really good, solid evidence and detail. So he's super. He and his business partner, Cameron Passmore, also have an excellent podcast called The Rational Investor. And I highly recommend your listeners to check that out too.
Notes taken. Andrew Hallam, thank you very much for being on Lux and Friends.
My pleasure, Carlo. It was great to be here, and it was great to meet you. Thank you very much.